Welcome. This is video lecture 1-3, where we're going to be doing a problem that demonstrates differential analysis. Differential analysis compares the status quo versus some alternative that is presented to a business. And the decision is whether to keep the status quo or to accept the alternative. In our example, we have a businessman who operates a florist service, flower shop, and we're given his monthly revenue and cost amount, which we've added onto our chart here. And we're told that he has an offer that he can work with a national chain and receive referrals from them. He'll have to pay a licensing fee of $1,000 to do that. Currently, of course, he does not have that fee, so the alternative will incur an additional cost of $1,000. Since we have in the alternative a cost of $1,000 and we have no current licensing fee, the differential is going to be $1,000. Now let's apply that same analysis to each of our items in this projected income statement. The problem tells us that if he accepts the referral business, for his $1,000, he anticipates an increase in revenue of 45%. So we'll take the current revenue, multiply it by 1 plus the increase of 45%. Excuse me, that's 40%. And we project his revenue to be $5,600. And of course, that's a difference of $1,600. Well, if that was the only difference in cost, obviously the increase in revenue would offset the licensing fee. However, he has to look at his cost and determine which costs will vary with activity versus those costs that will remain the same. And bear with me, I'm going to jump around a little bit here. The problem tells us that the rent will not change since it will still be using the same facility for both his regular business and the referral business. So his alternative rent cost and his status quo are zero. So we can say that rent does not vary based on activity, or we can say it's fixed. And we'll be talking more about fixed costs in our subsequent video. The problem also tells us that there are going to be certain changes. And it says that the flowers, the material, the supplies and labor will all increase by 45%. So these costs will vary based on activity, the number of bouquets that are sold. So we'll take the current cost for the material and multiply it by 1 plus the increase, and we can copy and paste that for our supplies and labor. And again, our differential cost is going to be our alternate cost minus our status quo. Copy and paste that. So we can see that while we'll have increase in some costs, other costs will remain fixed. These costs will vary. The rent is fixed. Now let's take a look at utilities. Utilities go up, but not the same percentage as our materials, labor, and overhead. So we'll take our status quo, multiply it by 1 plus the change, in this case 10%, and our utility costs will increase by $25. It tells us our other costs, miscellaneous costs that we incur, will also increase by less than the costs that are directly associated with the sale of a bouquet, and they'll go up by 20%. So we can see here that certain costs increase more than others as activity increases. That tells us that the direct cost of a bouquet, the material, labor, and overhead, have a different cost driver. Something is driving their cost increase at a higher percentage than the driver for utilities and other costs. Costs have a certain factor that causes the cost, overall total cost, to change, and these are called cost drivers. So let's take a look at our choices. Let's sum up the total cost for our alternative. Our revenue minus our total cost for the alternative produces an operating profit of only $720 versus our current $980. And when we look at the differences, we'll see that for our increase in revenue, the additional cost to choose this referral service will result in a decrease overall in operating profits of $260. So we have to reject this proposal. So what can we do? Well, we can go back and talk to the company about their licensing fee. Any costs that vary between the alternative is relevant to the decision on whether we should accept the alternative or stick to the status quo. But rent does not change. So in effect, it is not relevant to the decision-making process. So we look at our other increase in cost versus the revenue, and we can say that if the national chain agrees to reduce their licensing fee by the difference between what we are making currently versus if we accept their offer, we can then accept their offer. So let's go back and do this. Let's say we take the original terms, subtract out the reduced profit. Oops. If they agree to an amount of $740 or less, then this offer will be beneficial to the business. So we would look to negotiate a licensing fee of $740 less to maintain our current profitability. Obviously, we would try to go below 740, but we would use this differential analysis to determine whether we should accept or reject this alternative strategy.